Okay, good morning and welcome to Black Diamond Mortgage, our educational series. This is round two, and we'll be doing classes all the way into April weekly. And today is jumbo mortgages, and this is about basically big loans. And so I thought I would start off with a story of my first jumbo loan. So I started brokering mortgages in 2006. And when I first started, I had an opportunity. I had a guy reach out to me that wanted to buy a ranch in eastern Montana. It was like tons of acres. And he wanted to borrow $2.5 million, and he wanted to know what kind of terms he could get on a ranch purchase. And so, as I was looking at his situation, what was ironic was he started talking about what that might look like, but found out that he had a home in Whitefish that was worth $5 million. And I pointed out to him, I said, would it matter to you if the terms were better if we borrowed off the $5 million property in Whitefish instead of the ranch? And he's like, maybe, it depends. So we ended up, I ended up doing a $2.5 million loan on his vacation home in Whitefish, and he went and paid cash for the multi-million-dollar ranch in eastern Montana because the terms were better. And when you go to buy a ranch, there's all kinds of questions about the value of the property and whatnot. He knew what he wanted. So he just needed to be able to execute. So he got the best interest rate and the best terms by picking a great piece of collateral. And he got a jumbo loan. And that was my first vision and what it was like, because the property that I actually loaned on was the different property than the one that the customer called me to ask about. So we'll kind of talk about jumbo details in a little bit, but I also thought, why do we all like jumbo? Because they're big, and if you're getting paid on a percentage of the transaction amount, then maybe bigger is better. But I always like to remind people, if they haven't, have you ever read the book The Old Man and the Sea? It's a great little short Ernest Hemingway story. It's about a guy who's going after the big fish, and it kind of ends with him sacrificing everything for the big fish and coming up kind of empty handed. And so one thing I like to point out at Black Diamond Mortgage, we really focus on volume. And so one of our policies here is we actually cap our compensation here at Black Diamond Mortgage at the conforming loan limit, what we would make as a percentage of loan amount, because once the loan gets up to a certain size, it's really the same amount of work involved, and we want to be really competitive. So we treat them the same as everything. We just want to get a great deal for the customer. So I know some people get paid more if they do a jumbo, so they're going to be more interested. But as it gets more competitive, because everybody wants a jumbo. So what is a jumbo? A jumbo is a loan that's bigger than any of the loan limits of the programs that people are used to. So you have your Fannie Mae and your Freddie Mac. Those are the most common loans out there. Then you have FHA and VA. Essentially, what makes a loan a jumbo is it's bigger than those. So if currently in the year 2024, the conforming loan limit is at $766,000. So if you get $1 million loan, they call it a jumbo because it's not able to be backed by the Fannie Mae, Freddie Mac conforming loan limit. Couple small details. VA loans, if you're ever working with a VA loan, has no loan limit. So it wouldn't really be like a jumbo. It'd just be a VA loan, no matter how big it is, which is kind of cool. So if you know veterans seeking mortgages, they actually do better in the world that we would classify as jumbo. They can use that VA loan to an unlimited loan amount. There's basically those names I rattled off, Fannie, Freddie, all those things. Those are great sources of money for good interest rates, and the government's involved and it produces good loan products. But when they're bigger, those entities are no longer needing to help you acquire home ownership because you have that kind of money to spend. So now you're just dealing with banks in general. So then I kind of break jumbos into two different classifications as just a general thing when we're looking at them. But there's people that are just totally awesome, and then maybe they don't even need a loan, but they're going to take one and they're getting a jumbo. And then there's people who really need to borrow a lot of money and they kind of look different. So when you're going after a jumbo, if you're a borrower that basically doesn't even necessarily need a loan, the most important thing for that borrower is to shop the loan, because jumbos are all different everywhere that you apply for them. The banks are making their own loan on the property. They're not adhering to like a set of guidelines by one of the government agencies. So people that are, truly awesome, they have a lot of wealth and they're just getting a loan for whatever reason. They're going to be highly sought after by the lenders in the jumbo market, which means shopping is going to produce for that borrower a better interest rate and better closing costs. The other bucket of customer wants a big loan, and maybe they're striving to get ahead in the world and they're going to take out a big loan and they actually need, guideline enhancement or something to help them get a loan. So they're going to fall into two totally different scenarios. The one's just trying to get a loan. The other one can get any loan. They're just trying to get the best deal. So when you're first, as a mortgage broker, when I'm looking at jumbo, I'm trying to see, is this guy can get any loan anywhere? We need to make sure we get him the best deal, or do I have to put my best resources on just helping them close on a purchase? Maybe they're going for their biggest thing they've ever done. And so once we figure that out, then we start to look at all the different products available. So one thing I like to point out on jumbo is, do you actually need a jumbo? So sometimes, say you're buying a property and it's, in that jumbo realm and the purchase price 1.1 million or something like that. The first thing you want to look at with the borrowers is could you get a conventional loan at 766,000, make a down payment? Maybe you've already achieved the goal. Maybe the down payment can make up the difference. What if you just need a small second mortgage to go behind a first mortgage and get a really good $766,000 loan, and maybe get a $100,000 loan to marry up with it in the form of a second mortgage and produce better loan terms than going out and seeking a jumbo mortgage? So when a borrower is looking for a loan, there's these kind of things need to be looked at. Sometimes just achieving a high purchase price doesn't automatically make it a good idea to just run out and get a jumbo mortgage. Some of the products that have those government backing are a little easier to get and have pretty attractive loan terms. Sometimes there's examples in those government products where you can actually get higher loan amounts, like multi-unit properties. So FHA, VA, when you buy multi-unit, you can actually borrow a lot more than the $700,000 cap on Fannie Freddie. So that's something to look at. Another thing that comes up is on high value property, sometimes the seller will do a carryback on part of the sales price if they can get the majority of it up front. So your borrower might be able to get a $766,000 mortgage, and the seller might carry a $200,000-$300,000 note for a while until they can get into better financing. Sometimes that's better than a jumbo. And then other things that come in are just not just seeking one way of looking at it, like how are we going to get the objective? So say you've done all that and you're like, nope, needs to be a jumbo. It's got to be a $1.5 million loan, and none of those options make any sense. Number one thing to understand about jumbos is the lenders have their own guidelines for every jumbo. So it's not going to be like you just look online and see what the rates are on mortgages in general. It's going to be whatever that bank is offering at the time for the scenario. So as I mentioned, on a really awesome borrower, they're going to want to apply at least multiple ways of getting a proposal. As a broker, we actually do offer multiple lender options to the consumer. But if you're going bank to bank, you need to make sure that you're getting a good deal, because it's going to be different everywhere you go. Some of the things to think about with jumbos is as you get the loan gets bigger, the down payment or the loan to value ratio changes. So if you go, $10 million loan is not necessarily going to be 20% down. Lenders might want 30% down. You might be like, why is that? Well, when you appraise a $10 million property, it's a lot more subjective than a $1 million property. And so banks might just be like, as you get up into the higher numbers, the down payment often will increase. And so something to keep in mind. Credit requirements are generally going to be more stringent the higher you go. So as the loan gets bigger, the bank wants to make sure you're the kind of person that pays your bills on time. There's something in lending called reserves, which is basically how much money do you have left over after you take this loan. It's not part of the loan transaction, but it's a way to demonstrate your strength. Like if you spent all of your money to buy a $2 million property and you have no money left, a lot of jumbo lenders are going to decline you due to lack of reserves. How many months can you go after this loan closes if you didn't make any money? And so most jumbo lenders, as the loan gets bigger, they're also going to want to see more reserves in your bank account after the transaction's complete. So these are funds that aren't spent on the transaction, but they're analyzed at underwriting to see what your capacity is. So the bigger the loan, the down payment can increase. And then another thing is the debt to income ratio. So as a general rule of thumb, when you're doing those lower loan amounts that are under the conforming loan limit, the government will actually create some ways for people to have a higher debt to income ratio and still get a loan. As a general rule, when you're in the jumbo world, it's going to be more conservative. So the highest debt to income ratio you'll typically see approved on a lot of jumbos is 43%. Whereas on other products, you might be able to get up to 50%. And then they'll actually be even more conservative as the thing grows or as other parameters change. They're wanting to make sure that this big loan can be paid back with a reasonable income stream. Now, jumbo loans, the money can come from two basic places. One of the places is the bank itself. So if it's an example here locally in Whitefish, Montana, if you went into the Whitefish Credit Union, you take a big loan out, the depositors at the Whitefish Credit Union are where they got the money to produce the loan. You come into a mortgage brokerage, there's multiple funding sources, but we have secondary market, which is basically like traded mortgage-backed securities, similar to what Fannie Freddie are, but those dictate what rates get offered. And then large banks that work with brokers or in the secondary market will also produce loans based on the deposits made there. But in each case, the source of money is going to dictate the terms a little bit. So that's why you're going to get a lot of different looks on jumbos. It's not just one instrument like the Fannie Mae mortgage-backed security being traded. So when you're looking at those different sources of money, they all look at the loans differently. So credit unions do a little differently than banks. Secondary market does a little bit different. Some of the differences you'll see are in like secondary market sources, they might put some arbitrary acreage restrictions on the loan or something like that. Like they might just say, if you imagine the community of Malibu, California, they have lots of multi-million-dollar homes, but they're all on small parcels because they're like at the ocean. So they would be like, we're going to do all of our jumbo loans. A bank that like to lend to them might be not wanting to loan more than a couple acres of land. Whereas a lender that's more focused on rural America might be fine with acreage. In Montana, we value acreage. So in Montana, the acreage can be valuable. You get into like urban areas and acreage is like so different than the high value properties everybody's looking at that it's hard to determine what the sales capability of those properties are. They're just totally different. So some lenders will just impose some restrictions because if you go look across the country, you might see a lot of resort property and things that are low acreage that can be high value. And they'd be like, we're going to focus on that. And so that lender might have an acreage restriction. Another lender might not have a restriction like that. So when you're getting into jumbos, like these things will come up. So if you just apply generically at some lender that says our rate on a mortgage is this, and we offer a jumbo, they may not offer the one that works in Montana on a 40-acre property. Another thing in Montana is when you do buy a lot of acreage, there's actually a thing in Montana. It's unique, but when you get into high value property, if it's over 40 acres, there's actually a different recording instrument used for the property. If it's under 40 acres, you use what's called a deed of trust. And if it's over 40 acres, you use what's called a mortgage. You're like, well, I thought it was a mortgage, but a mortgage is a different instrument. And the basic difference on it is if a bank needs to come back and collect on due to lack of payment on a mortgage, the borrower has a year to catch back up. And on a deed of trust, you get your 60-day notice and they start the foreclosure proceeding. So some banks don't want to do business if they have to have that 1 year catch up available to the borrower. And that'll just be an automatic, don't want to do a loan that has that feature on it. So having lots of options, you can sort through those things and figure out what the best way to get a mortgage is. Sometimes in the world of jumbo, you'll see like occupation specific loans, like doctor loans. What are those? So you'll have lenders out there that'll specifically target a class of employee that is a good borrower. And they'll be like, doctors are good borrowers. And so if you're a doctor, you can put a little bit less down. Maybe you can exclude your student loans and you can borrow $2 million right out of college, and maybe that's different than all the other loan products. So when your borrower is seeking a jumbo loan, if they have an occupational opportunity, they might get a special product offered to them just because of that. One thing you'll see in the jumbo world that's a little different is ARMs are a little bit more popular than fixed rate mortgages. They still do all the same fixed rate. You can do the 30 and the 15-year fixed rate. But people that are dealing in higher dollars are less concerned about that long-term interest rate as a general rule of thumb. And the lenders are also less interested in being in the loan for a long time. So they will incentivize the adjustable rate mortgage. And the rationale behind that is the wealthier you are, the more you're moving things around. Like if you're buying and selling lots of property, you're making lots of money, you're buying businesses, selling businesses, you might come into $1 million and just pay the loan off in a shorter period of time than the average person who's just working their paycheck and their mortgage over time. So the ARM is both better to the borrower and the lender in the world of jumbo. So don't be scared of ARMs. If you're working with a client who wants an ARM, it can be actually win-win. The fixed rate products are available, but sometimes the ARM is a lot more attractive. Some other differences with a jumbo and a regular mortgage that are worth noting. Property value considerations. So the larger the loan, the more subjective the value of the property is, because why does somebody want to pay such a big number for something? So it wouldn't be uncommon as the loan gets bigger for the appraisal to be more scrutinized by the lender. So if you're, say you're a realtor working on a jumbo transaction, you might freak out when you find out that they go for a second appraisal. But it could be that first appraisal determined that this is a highly unique property and there really isn't anything else like it in the community that, and we want to make sure, like, if it's worth $5 million, it's not really worth $4 million. And even with all the information in the appraisal, they're like, you know what, we're going to need a second opinion. So as you do more and more jumbo, you start to see that the lender is more and more concerned about, is this property worth what we're going to use as collateral on it? Another thing that happens a lot on jumbo, and I think it's just higher value property in general, is the inclusion of personal effects in the buy-sell contract. So lenders don't want to lend on personal effects, but sometimes somebody's going to walk into a really nice home and they'll be like, I love the home and the furniture and the art. I'll take all of it. Well, that's probably a great way to make a sale, but the lender is not going to be able to use the art and the furniture as collateral if they ever come back and take the home. So sometimes we'll see buy sales come in and they're just a lump sum purchase price. And we end up having to go back and break out the personal effects, the things that aren't part of the permanent collateral. So on jumbo transactions, you have to keep in mind the collateral is just the real estate. Sometimes, as I mentioned a little earlier, different lenders are going to view land differently. So some are going to look at land as valuable, and these are the ones that specialize more in ranch and home lending. They like land. And then the ones that are more urban don't like land. So when you're looking at loan terms and options, a good thing to look at early is, does the property have a high land to home? Is it more land than home, or is it more home than land? As a general rule, you get way more options if there's a nice home on a reasonable sized piece of land. The bigger the land is, there'll still be some options, but there'll be less options. And then A lot of times on big value property, there's multiple parcels involved. That also has to be looked at quickly up front. And there can be easy ways to tackle that. Sometimes you can do a higher loan on the more valuable parcel. And if they're making a down payment, they might be able to just buy some of the other land with cash and just take out a loan on the more desirable lending parcel. But if there's like three parcels all stacked together, that might be a great deal for the buyer. The lender may or may not be excited about having three parcels under one mortgage. It can be done, but it adds complexity, and not every lender is going to love that. So I wanted to get into some kind of interesting jumbo scenarios that come up that are good to look at. So some of you may have heard of what's called non-QM lending, or qualified mortgage versus non-qualified mortgage. The cool thing about it is non-qualified lending is basically the lender gets to make more unique decisions. That includes how the borrower is qualified and sometimes the property. So borrowers that are able to make decent down payments, that have tough to qualify income scenarios, the non-QM space likes big loans if they're good. So if there's a way to qualify a borrower off of bank statements or off of a really nice piece of collateral, and they have a down payment, but maybe they don't have the most amazing looking tax returns, the jumbo space actually looks good in what they call non-QM lending. Those lenders are really just looking for good loans. And so if they can find a good loan that's bigger, they actually like it more, which is kind of a nice option for people that some people will go in to apply for a jumbo mortgage and they'll find that the underwriting's stricter and they'll start to get frustrated. Non-QM is a great way to solve that, and it gets better as the loan gets bigger. You'll have people out there that are asset rich but income poor, kind of like I was just mentioning. There are lending options that are, we're actually, Zach's going to be doing a class on this next week called asset-based lending. And essentially, there are loan products that look just at the borrower's assets and not so much at their income. And they develop a way to qualify the borrower. And so the people that have a lot of wealth, but they're very good at avoiding taxes, they can use what's called asset-based lending. And the cool thing is all that lending is basically jumbo. They don't look at those government products, so they're all underwritten like jumbos. One thing that can come up that'll surprise people sometimes is the trust funder borrower. So a good jumbo lender will look at a kid of a wealthy person who might have a lot of wealth, and they will want to try to figure out if they make the money or the parents make the money. So an area where you can get a little surprised is if the underwriter can figure out that the kid actually doesn't know how to make any money by looking at the kid's stuff. They might, even though the kid's applying and they have wealth and they look great, if it looks like all that comes from mom and dad, the lender might want to go, I want to see mom and dad. And that might freak the young borrower out. Doesn't always happen, but the reality is the lender's trying to figure out who makes the money, how's this loan going to get paid back. And so sometimes when you're looking at in a wealthy town like Whitefish, for example, or Big Sky, you might have somebody come in the door who's looks wealthy because their parents are wealthy, and they start going through the loan process, and you're like, how are they running into trouble in underwriting? It's because the bank is able to size up that they don't actually work. It's their parents. Doesn't mean you can't get a loan, but you might have to deal with that kind of thing. On jumbos, one thing that's important is the way that you get approved. So a lot of people apply for mortgages in general. They run automated underwriting scenarios and they get approvals pretty easy. When a borrower is getting a jumbo, it's more important that they do all the work up front because the analysis is going to be more in depth. So the borrower's like, yeah, I make, $1 million a year, and they put that on their application and they apply for a mortgage, and the computer says, yeah, it'll be a good mortgage. We just need to see their tax returns, those type of things. It's really important on a jumbo that the borrowers had those tax returns analyzed before they go out and make offers on property, because the computer automated system is not going to be nearly as comprehensive as what the underwriter is going to do manually when they look at the paperwork when it comes in. So if you're working with a jumbo borrower, we see this a lot at Black Diamond Mortgage. We'll have people that were, quote, pre-approved at a lender, and then they're running into trouble. And when we finally get the file, it's because they didn't really do a real underwriting analysis, and so more work should have been done up front. The one thing I always like to say is on jumbo, they're bigger, there's more to them. The number one thing to do is just ask lots of questions. So if you make assumptions, you're probably going to walk yourself into trouble on a jumbo. So a good way to do it is to just try to put as much information up front as possible, try to see how this loan's going to look to a lender, and then proceed rather than just assume. I guess I should say, unfortunately, the jumbo customer often comes in and says, I'm really awesome, I'm good for this loan. And then like they either are or they aren't. And so weirdly, the more awesome the transaction is, meaning big, the more upfront due diligence is recommended, because there's more consequence and there's more likelihood. If somebody's able to put $4 million into something, there's going to be a lot of a story to tell about their finances. And so could be a great story or it could get a little weird. And so the more you can know up front, the better. With that, I wanted to see if there are any questions out there or in the room here. Does anybody wonder anything about a jumbo mortgage? Oh, what a nice crowd.
Are they more common now?
Kyle is asking, are jumbos more common? I would say their percentage of the marketplace probably hasn't changed a lot. If anything, it might have gone down a little bit because they keep raising all the other products to higher balances. So I would say, from what I can see, it's probably smaller than it used to be. People are able to borrow $766,000 on a Fannie Mae Freddie Mac mortgage. So I was actually looking up my notes to do this presentation, and I have done a 1 hour version of this jumbo class just a couple of years ago, and I was saying in that class the limit was 431,000. So it's $330,000 higher just a couple of years later. The cool thing about that is it's the average loan officer can easier process all those regular products, Fannie Mae, Freddie Mac, FHA, VA. Those are easier to process mortgages for loan officers because everything's just sitting right there in a manual and the computer does half of it for you. So it's like the consumer gets a better, easier close going after those mortgages. And then if you're outside of that, that's where you need to be dealing with people who really know what they're doing, because it's not going to be a uniform set of guidelines. So I do expect to see jumbos go up in the future because property values have climbed. I do think, as I see in Montana, a lot of people are interested in high value property. What we've noticed in just the last couple of years is they were figuring out how to do it with less mortgages. But I think once they start leveraging and doing the next things they're going to do in their life, they're going to be coming back to get mortgages on these properties because they're worth a lot. And so then they'll be taking out a jumbo mortgage. So it does fluctuate. So when I went through the 08 housing crisis, jumbos, anytime you go through major market things, jumbos tend to get hit harder than the other stuff because the other stuff has the implicit backing of the government. And banks offering jumbos are just on the hook for whatever they do. So if banks are getting scared, where they take it out on is the jumbos. They'll just kind of hold back on jumbos until they figure out their financial situation.
One thing I see is that sometimes when people are in the jumbo category, they are actually telling agents that they're going to be paying cash. However, the client will likely be getting some kind of loan. Dave, can you give some tips for agents on how to kind of navigate that? Because one of the things that would be good is for agents to know that as like not necessarily a red flag, but just like a way for them to give the client some resources.
Sure. Well, one thing that's common is a borrower can take a loan against a different piece of collateral and pay cash for the one that they're buying. And they can technically write an offer cash and be honest, but actually be getting a loan. And maybe nobody figures that out until in the middle of the process. So one thing to do is just, I've seen some realtors go see where are they getting the cash from, and there's some legitimate ways to verify that. I've even had realtors ask me to work with the bank to validate what part's cash and what part's loan. So I think if I was on a listing agent side, for sure, I might want to just, if somebody's going to show up with $2 million cash, I might want to, as I'm going through the due diligence process, just go, yeah, where's the two, I don't need to know your whole personal situation, but is there a third party that can validate your ability to come up with $2 million, and not everybody does it. I think it's a great tactic. I think just the main point is probably just that, is like, see if you can figure out how it all adds up to a closing, and don't just assume everything's hunky-dory. Even with a lender approval letter, there could be a lot of cash coming to the table plus a loan. So it doesn't hurt early in the process to do some screening of a lot of that information. It could save a lot of drama later in the bigger the transaction, the bigger the consequences to everybody if the details aren't checked out. So I've seen that too. Anybody out on the internet have a question? Well, I appreciate you guys coming. Zach next week's doing asset-based lending, and you can take a look at our sign up and our curriculum offering through the month of April. We've got stuff going every week, so appreciate you being here. So.